Hello everyone, welcome back to my channel. So recently I've been giving the book by Peter Lynch a good read. It's probably because after the GME fancy, I felt like I missed the million-dollar opportunities. So I know that this book is talking about how to find the 10 baggers in the stock market. So I was very interested. And after reading the book, I think it's really worth reading. Maybe not one time, but many times, because there are so many strategies and unique insights that we can learn from, definitely.
Magellan I still use today. I think they make sense. I think they make a lot of sense for investors, and I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. I think the public can do extremely well in the stock market on their own.
Today, I want to talk about several takeaways from this book, and hopefully that will be helpful to you guys. So now let's get started. First, a brief introduction about Peter Lynch. He used to be the money manager of Fidelity's Magellan Fund, and that was a multi-billion dollars fund. During Peter Lynch's leadership from 1977 to 1990s, the fund is one of the best performing ones, which is annual return about 27%. And Peter Lynch is also one of the investing gods that a lot of investors want to learn from. So now I will share some of the takeaways from this book. First, the takeaways from this book is that he thinks individual investors have better advantage comparing with institutional investors. The first reason is that institutional investors has larger asset size, so when they want to buy or sell the stock, they actually move the market. So that means they cannot get the price at the optimal level. But individual investors, they have smaller fund, and their buy and sell will not affect the market, so they would probably get the price they want. And the second reason is that he believes individual investors like you and me have an edge on specific areas. For example, the people who are working on the oil industry may know how the industry works better. And the people who are working for pharmaceutical companies, they would probably know the pharmaceutical stocks better. For the people who have a better knowledge in a specific industry, they may get some information or they get the insights months before Wall Street analysts. So that's why they can buy the Tenbaggers stock at a very early stage before the Wall Street even discovered it. The third advantage of individual investors is because he thinks investing is art rather than science. And we also see an example that for this year, a lot of fund managers, they lose money, while a lot of individual investors make money on a GME stock. We always think that institutional investors, they have better access to data like Bloomberg Terminal and better technologies like the algo trading. They must have a better advantage, but the truth is it's not really. And investing is not just purely mathematics. It has to do more with the psychological part like behavior, financial. So that's why some unique thoughts can also make a big impact in the investment performance. So how to find 10 baggers? There are some main methods that I summarize. The first important thing is look for something you actually understand. So in this book, it gives like 20 stocks that has been 10 baggers in the 1990s. So when we are thinking about 10 baggers, we may think about in the tech companies, but surprisingly, some of the stocks are actually in the traditional industries, and they also achieve tenfold returns, something like Home Depot, Gap, and Lowe's. We can notice that there would be 10 baggers possibilities in every industry. So Peter Lynch's opinion is that it's very important to invest in something you understand. And one of the examples of his 10 bagger stock pick is Dunkin' Donuts.
I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle.
He invests in stocks because he understands the business and he saw the growth of the company. He also saw the increasing number of the company stores and the company growth. In the end, Dunkin' Donuts stock becomes a 10-bagger for him. So after we find the companies that we can understand their business model, the next step is to find which one has tenfold potential. And Peter Lynch has divided the stocks into several categories, including slow growers, stalwarts, cyclical, faster growers, and turnarounds. And for his opinion, he thinks that the fast growers and turnaround has the most potential to become a 10-bagger. The reason is actually very simple. For fast growers, since its earnings per share has been growing and it will later be affected in its stock price. So for fast growers, he liked the stock which has EPS growth around 20% to 25%, but the growth rate not too high, like over 50%, because he thinks if the company grow too fast, that means it's not sustainable and it's not gonna get a success in the long term. So I think one of the fast growers example can be Apple stock. Instead of a one-shot deal that you buy the product and that's it. Apple has created an ecosystem where the users can enjoy the synergy effect. So that's why Apple can launch new products and the consumers are very sticky to their new products because Apple has the data and they can provide better service for the customers in this ecosystem. So I think that's why Apple can maintain the growth and would be a winner in the long term. And the next potential 10-bagger features is a turnaround companies. So some companies may have some problem right now, but they are trying to fix a problem and restructure their companies. And after that, the stock will have a very big jump. So one example in this book is Lockheed Martin in 1980s. At that time, Lockheed Martin's earnings for its defense business is around $8, but it lost $6.5 per share for its commercial aviation division. And because of that, the companies kind of struggle with their stock price. Stock price at that time is $15. After the management realized that, they get rid of their aviation division, have a write-off in 1981 for a one-time loss. That means they get rid of the division that doesn't make money and keeps the division that makes money. And after that, within 4 years, their stock price has hit $60 from $15, which becomes a 4-baggers. Now we know that what type of companies has the potential to become a 10-bagger, which is either a fast grower or a turnaround. There's more features Peter Lynch gave us to filter out the 10-baggers. One of them he mentioned is that looking at the smaller companies rather than the big companies. That is very easy to understand because smaller companies makes a big move while big company makes a small move. So another features of the potential 10-baggers would be that institution investors owns less shares of it, or fewer analysts has covered the stock, or even no analyst has covered the stock. So that criteria reminds me of some companies that maybe just IPO'd and are still very small, so that the analyst hasn't discovered that yet. So that shows they still has the potential that later on, maybe the Wall Street realize it and invest in it, the stock must have a big jump. So if investors invest it before that, they would be able to achieve very high returns. Some other criteria is to when to buy these 10-baggers. So Peter Lynch suggests that we look at the PE ratio. We want to compare the current PE ratio with the historical PE ratios to understand that whether we buy the stock at a higher price or a lower price, and also not just compare the historical PE ratio of one company, but also compare the PE ratio of the sector to see that whether the stock is on the higher end or the lower end. because the purchase price will also affect the total returns on the investment. And the last but definitely not least is to look at the balance sheet. So two things we want to find out is one is the debt equity ratios. If the company has a huge debt, that would add more risk to the investors if the company has a risk of bankruptcy. And another thing is the cash position, which will decide how low the stock price can drop. One of the example is that if Ford has $16 in net cash per share, that means that Ford stock is unlikely to drop below $16. I think that gives the investor a guide for the potential risks they may encounter. So after we identify that which stock has the potential to be a 10-bagger, Peter Lynch has also recommended that how we allocate the portfolio and when do we trade. He thinks that investment is not a sprint but a marathon. If we want to be the winner in the long term, we cannot be very rushed in the short term. Like he mentioned that buy the stock at a reasonable price, and he gives the example that if investors bought Walmart when it's just go public, they may have a 5 times return. But if they wait for 10 years for the stock price dropped and then they bought the dip, that would be 30 times return. And as for the capital allocation, he mentioned that because he managed a multi-million fund, so he wanna allocate 25 to 30% to the safety stock and only around 15 to 20% into the 10-baggers. That's also some portfolio allocation that we could take into consideration. So in a word, I think I benefit a lot after reading it, because the main thing about the book is to tell us how can we make money based on the knowledge we already have and how we do our homework before we do the trading. And when we do the homework, looking for the PE ratio, the balance sheet, it's important to know which numbers really count. Yeah, that's my takeaways after one time reading of this book. I would highly recommend it to you guys to also give it a good read, because I think the insights and the strategy of Peter Lynch is timeless. That's all for today's video. Thank you guys for watching, and I will see you guys in my next one. Bye!